In your experience, what are some common tax deductions YouTubers often overlook?
All of them. I was just talking to a client. They own a studio and they helped train actors. They recently went on a trip that they paid for personally to see some shows in Broadway. Now, typically speaking, entertainment under the current tax code is not a tax deduction. But is this entertainment for someone who is training other actors and actresses? I would argue in their case, this is not entertainment. This is research and development.
Got it.
They have an obligation. It would be entirely ordinary for someone who's training other actors to go and study current trends.
Yeah.
And arguably, it's necessary. How are they going to continue to compete unless they can be relevant and talk about current events and what's happening for these people who are aspiring themselves to maybe make it to Broadway at some point? And so that travel and those tickets is research.
Here's the big question. Are you ready to reach new limits?
All right, today I've got my buddy Dom, who has a thriving YouTube channel called It's Circle Time. It's good that he's got something thriving because he's got that ugly Chargers hat on, and that's the team who's not thriving. But his YouTube channel is killing it. And today we're just going to jump on and talk about how to rig the tax game for YouTube creators like Dom.
I appreciate that. Already from the get-go, you throwing jabs, and it's usually them Seahawks that usually throw the jabs right at the 2-yard line that would say something right at the top of the video. But thank you for having me. I'm gonna just tell you, I'm gonna share this quote that I've had in my phone for years, and I did not know when I was going to use it, and this was like the perfect time. And so this is a meme between the government and myself communicating back and forth. And the government says, "You owe us money. It's called taxes." And my response is, "Well, how much do I owe?" And the government says, "You got to figure that out." And me, it was like, "So I just pay what I want?" And the government's like, "Oh no, we know exactly how much you owe, but you have to guess that number too." And then my response is, "But what if I get it wrong? You go to jail." Why is it that taxes just feels like a third or fourth language way off of what we're used to? And why does that meme resonate with not just me, but many other YouTubers and small business owners out there?
Well, the first thing that comes to mind, and something that I try to say to every new client or any prospect that I'm talking to, is that a lot of the things that I'm going to teach you are arbitrary rules.
Okay.
In other words, you might be really good at logic and reason, and it doesn't necessarily apply in the tax code. You either know the rules or you don't. I often joke that the tax code is sort of like your parents growing up. You're like, "Why do I have to do that?" The answer is because I said so.
Yeah.
And so if you actually know the rules, then you can rig the game. But most of us don't know the rules. And I say most of us don't. I'll even include some CPAs, because I have looked at some dumpster fire tax returns almost every day. And I have these very triggering conversations with clients where I'm walking them through, "Hey, these are your returns. Look at all these things that were missed." And they didn't know that. Why would they? Because oftentimes a tax return is 40 to several hundred pages long.
Yeah.
And like you said, it's very much a foreign language. So you need someone who can translate, but not just translate in a way where they give you all the code sections, because that's what a lot of accountants do. Is you ask them, "Hey, should I buy a vehicle in my personal name or under my business?" And you get like a 6-paragraph response back. Like, "Hey, I still don't know actually the answer. I thought I asked you like a question where you could just say, buy it with a business or buy it personally, and you gave me 6 paragraphs back. I'm not looking to become an accountant." So there really is a struggle out there of helping small business owners and individuals so they understand what they can do, empower them, but not give them so much where they feel like, now I'm an accountant. I basically just got a degree without the diploma.
That's what really I'm intrigued about with you and the book Rigging the Game, is making the language accessible and understandable for people to be empowered and moving forward. As you know, Dan, I started a YouTube channel about a year and a half ago, and I'm starting to see some revenue come in. And it's a new venture for me. And I'm just sitting here going, how do I start? What do I need to do? So I have an assortment of questions, if you don't mind answering, that would really not only help me, but I feel like any future YouTuber and existing YouTubers out there who are maybe making a lot of money, but might find some nuggets here or there that could help them maximize and essentially give them more freedom in the financial world.
I love it because tax as a creator, content creator,
Yeah.
Taxes are quickly going to become your biggest expense. Now, on average, small business owners are paying 40 to 60%. So it can quickly become the biggest expense.
Yeah.
Especially if you're really successful, you're paying the equivalent. I like to state things in units of measure that people understand. It's like you might have a tax bill that's the equivalent of you could have just bought a Tesla or a couple of Teslas. So that's a decision when you make a expensive purchase like a vehicle that you might spend a bunch of time researching and trying to figure out. Meanwhile, taxes, a lot of times, is just happening to people.
Yeah.
They turn in a bunch of stuff, they get a return back, and it's like, oh man, I owe a ton of money in taxes. And there is a completely better way to do this. And you're only required to pay the legal amount. And the legal amount can oftentimes be zero if you understand the rules and the incentives. Congress creates incentives. Now they're constantly changing what those incentives are, but they're trying to incentivize business owners, consumers, individuals to take certain actions, and they're giving a tax benefit for you to do that. So how do you rig the game, fund what you want, get those incentives, pay less in tax? That's what I'm all about.
The first question I have for you, Dan, is does YouTube handle any part of the tax process for content creators, like withholding taxes, or is that entirely up to the individual or the content channel?
It depends, and it depends on where you live. So let's talk about U.S. taxpayers and non-U.S. taxpayers.
Okay.
So a U.S. taxpayer, before you're going to get paid, YouTube's going to ask you to submit a form called a W-9. Okay. And that W-9 is giving them your information, your name or your business name, your tax ID number, an address, the type of company that you've set up, or again, you might just be an individual. And then there's this thing called backup withholding. Does that apply to you? And you'll know if it applies to you because you've gotten a bunch of IRS notices and essentially you owe them a mountain of money. And so they're making any vendor withhold a percentage of their payment. So most of us are not going to be subject to backup withholding. You're going to know about it if you are. Okay. And so you give that W-9 to YouTube. And again, as long as you're not subject to backup withholding, they're not going to withhold any taxes, federal, self-employment tax, income tax. We got to keep in mind we have 89,000 state and local governments in the U.S., up from 82,000 state and local governments in 2003. So in 20 years, we've added nearly 7,000 state and local governments. So we got to be mindful of not just federal IRS, but state, city, county, etc. So YouTube's not going to withhold any tax, again, unless you're subject to backup withholding. Okay. They are going to issue you a 1099. And a 1099 is really just the equivalent of what a W-2 for the self-employed. So they give you a 1099. It shows you how much they paid you for the year.
Yeah.
And they're also going to submit that to the IRS. So the IRS is going to know how much you were paid. From there, you're going to have to report at least that amount of income. You might have more income to report than just what you got from YouTube, but at least that amount of income as revenue.
Okay.
Otherwise, you'll get an automatic notice from the IRS. It says, hey, YouTube says, just for example, they paid you $1,000. Your tax return only shows $900 of revenue, sales. There's a $100 difference. They're going to automatically calculate additional tax on that $100. Okay. So it has to at least add up. Doesn't mean you owe anything because you might have deductions that take that number down to zero.
Okay.
Now, if you're outside the U.S., it gets even a bit more complicated because, again, it depends on the country that you reside in. So the U.S. has tax treaties with a number of different countries, and they have some countries that they don't have tax treaties with. inside those tax treaties specify how much withholding a U.S. company has to do when they're paying a non-U.S. vendor. And that will range from 0 to 30%.
Wow.
0 to 30%. If you don't know or you don't fill it out, the standard is going to be 30%.
A third of your revenue.
Essentially.
Oh, wow. Okay.
That will be withheld by YouTube. And typically you'd fill out a form called a W-8-BEN, and that's the form you fill out to reference whatever tax treaty might apply to you. And again, that will specify in that tax treaty how much YouTube needs to withhold. That's really something you're going to need a CPA to help you fill out. YouTube is going to withhold that tax. Then if you want to get it back, you'd have to file typically a U.S. return, show that you don't have any U.S. sourced income, and claim a refund. That would be the typical process.
Okay, Dan. At what point do YouTubers need to start worrying about paying taxes? Is there like a specific threshold that I should be like, oh, okay, like maybe I should set this aside? Or
the taxes is a broad term because again we have 89,000 state and local governments in the U.S. and so we kind of break it into these different buckets of we've got federal tax system, and that has an income tax and then a self-employment tax.
Okay.
So there's two pieces of that. Then we have state income tax. We have 43 states that have a state income tax. Then we have city and county taxes. So let's just speak to specifically federal income tax for simplicity's sake, because again, there's 89,000 state and local governments. So that's a lot of potential scenarios to confuse folks. Also a lot of potential opportunity to minimize your taxes. So where there's complexity, there can also be opportunity. Where there's complexity, there can also be opportunity if you get with the people who understand the complexity and they can make it simple. Anyhow, let's talk about federal tax really quickly.
Okay.
We have the income tax. Those are those brackets that you've seen that go from 10% up to 37%.
Yeah.
They're marginal brackets, meaning it's the next dollar that's taxed at the new rate. So a lot of times people think if I go from one rate to another, now all of my income is taxed at this higher rate. And so they'll say things like, I shouldn't make any more money because I'm going to move into this higher tax rate. And they're thinking everything is going to be taxed at that new rate, but it's just the next dollar in that bracket. So those are income taxes. And that's where you're going to take all your different sources of income, business income, wages, etc., add all that up. And then we take that to the brackets. And then as a business owner, if you haven't done some strategizing to figure out the right entity structure, and you're just a 1099 or what would be generally called a sole proprietor, once you get over $400 of income, you're going to be also subject to the self-employment tax.
Okay.
This is the one that is a slap in the face to the new business owners who were looking at only the brackets and didn't realize about the self-employment tax. They're like, how do I owe so much money? When you're a 1099 contractor, it's to set up an LLC. Either way, you're taxed as a sole proprietor, and 100% of your profit as a sole proprietor, 100% profit, sales or revenue minus expenses or tax deductions, that number at the bottom, that profit number, 100% of that is taxed the same way as wages. Wages get the federal income tax. They also have Medicare and Social Security taxes withheld at a 7.65% rate. But when you're a W-2 employee, you have 7.65% withheld. Your employer matches 7.65%. So the combination is actually 15.3%. Now, there's some other complexities of when that rate goes down. For simplicity's sake, we're just going to hold on that. But you need to look at your marginal tax bracket and then also factor in the 15.3% self-employment tax. It's going to kick in once you have more than $400 of income.
Okay.
All that to say, if you're making, once you get over $400, you need to start saving for tax. Once you get over 10,000 or more in self-employment income, you need and you think that's going to continue, you're really going to need someone to at least give you some strategic direction
Okay.
on managing your taxes. Because now we're looking at, on a $10,000 in income, on self-employment income, we're looking at least $1,500 in tax, self-employment tax.
At the minimum.
At the minimum.
Yeah.
Again, I'm doing some rounding and stuff for simplicity's sake, but roughly $1,500. And then that could just continue to grow. So that's, to me, the inflection point where, okay, now $1,500 is a meaningful amount. You probably need some professional help if this is going to be an ongoing thing.
Got it. Which brings up, I think you kind of started summing it up, but thinking about incorporating as a business, what are the benefits other than like what you were saying, kind of minimizing the kind of taxes? But I'm very curious as to if I'm a YouTuber and I do go past that $10,000 threshold, incorporating it to a business. Are there any specific like strategies on which business type I should get?
Absolutely. There is some strategy on which business type you should go with. And the IRS has these categories: sole proprietorship, partnership, S corporation, C corporation. Now, people always ask me, what does the S stand for? What does the C stand for? Because it seems like it should represent something. And it literally just represents the chapter of the IRS, or it's Internal Revenue Code, that controls all the rules. So literally, I find this to be amusing to me because I feel like it should stand for something fun, but literally C in C corporation, that C just stands for the subchapter C, subchapter S.
Got it.
And so they don't actually represent anything. Now, I didn't mention LLC in any of those categories: sole proprietorship, partnership, S corp, C corp, because it's a relatively new construct. And so when LLCs came into existence, it's more of a legal liability structure more than anything. And so if you're just if you form an LLC and you're the only owner, by default, you're slotted into the sole proprietorship rules.
Okay.
If you have more than one partner, or what would be called a member within an LLC, you are by default slotted into being a partnership. And then you can make an election to be treated as an S corp, or you could convert to being a C corp. And so nowhere in there in the code is a specific set of rules around LLCs. All that to say, the reason for setting up an LLC is more about legal liability protection than taxes. I typically recommend it because we're trying to create a separation between our personal assets and our business assets.
Yeah.
But it doesn't necessarily control how you're going to be taxed. It becomes a matter of, do I want to be taxed as a sole proprietor or partnership, or does it make sense for me to elect to be another entity? Okay. Now, for C corporations, there's a bit of simplicity there because typically I say be a C corporation if you're going to bring in outside investors. They're going to probably mandate that you're going to be a C corporation, or you're running typically a technology company that's going to qualify under this special tax provision called the 1202 exclusion, or qualified small business. That's a technical issue we could maybe talk about another time.
Yeah.
But if you're going to get this potentially significant long-term tax benefit, C corporation would make sense. So rarely for a YouTube content creator or a small business owner is C corporation going to make sense. So we're really looking at, when does S corporation benefit me? S corporation really benefits you in terms of minimizing the self-employment tax. That's how the self-employed pay into Social Security and Medicare. That's that 15.3% rate that eventually goes down to 2.9. And again, these are arbitrary rules, so you can't logic your way through it.
Okay.
When you're a sole proprietorship or partnership, all of your profit is treated as a wage. So it gets the income tax and it gets the self-employment tax. When you elect to become a S corporation, you become both a shareholder and an employee. And so there's this delineation now between you being a shareholder and an employee. An employee has to receive a reasonable wage, and that's based off facts and circumstances. We have a whole methodology and way of documenting that meets the Tax Cuts and Jobs Act and how to help people figure out that number. So we figure out a reasonable wage. That's going to get the income tax and that self-employment tax. Anything that's left over doesn't get that self-employment tax. So let's give an example. You're making 100 grand in profit.
Okay.
We determine that there's wages, reasonable wage is 40 grand. That 40 grand gets the federal income tax and it gets the self-employment tax.
Okay.
The 60 grand that's left over still gets the federal income tax, but it doesn't get that self-employment tax. So now we have 60,000 that is not getting that 15.3% rate. So 15.3% times 60,000, that's about a $9,000 tax savings. In that scenario, it's going to make sense, even though you're going to have a few extra costs of a separate tax return you'll have to file and getting payroll set up. There's enough savings where that typically justifies it. If your reasonable salary was 100 grand and you had 100 grand in profit, you end up in the same place as if you didn't make the election.
Got it.
Because all of that profit is being paid to you as a wage and getting that self-employment tax. If you have to pay a wage that's higher than your profit, then you're worse off, because now you're paying a wage, you're creating extra self-employment tax. I've seen that happen a bunch of times where people are like, they're giving themselves a fat wage, feeling good about themselves, bragging to their friends, and then over their return, they're like, you got a loss. You paid an extra 7-8 grand just to say you have a cool and self-employment tax, just to show you got a cool number on your W-2. So it's really making sure that that wage is lower than the profit. Ideally, best case, and sometimes it is if you're not actually actively working in the business, but in the example, you had $100,000 in profit. If you weren't a S Corp, you pay about 15 grand in tax. If you could justify no wage, a zero wage, you'd save 15 grand in tax. That's the kind of illustrating the extreme. So we want to have a gap between the wage and the profit. If you can get there, S Corp probably makes sense.
Okay. Last question between in this category of like starting up a YouTube channel. Besides setting aside the money for taxes, what other financial reserves should the YouTubers consider maintaining?
I recommend that everyone has that's making $10,000 or more have a tax estimate done, so you can get as close to an actual accurate number to be putting aside. And in particular, having that exact number, if you become an S Corp, then you're on payroll and you can automate having those taxes paid in through withholdings.
Okay.
So say you owe 12 grand, it's estimated in income taxes, and you pay yourself monthly, 12 grand divided by 12 months, $1,000 a month. You just have $1,000 taken from your paycheck, and that just becomes a thing that you're used to. It's just part of your lifestyle. Because I can tell you that anytime you have to make the quarterly or annual payment, even if you knew it was coming, it spins you out, because you're like, I used to have X amount in my account and now I have this. And I knew that was coming, but it's sort of a loss hurts more than an equivalent gain.
Got it.
So ideally we automate the taxes being withheld, and it becomes part of the kind of baseline for your life and what you have available, so you don't have that experience of the money just vaporized, because the IRS does not send you a thank you card. I can tell you that. I've had some large tax bills. I've planned for it. I got it down as much as I could. I've been fortunate in some instances to have some successful investments or otherwise. And I've spent some fairly large checks, no flowers back, no chocolate, no thank you cards, no happy birthday, right? So it's just gone out of your account.
Yeah.
So trying to sort of systematize that is the ideal. If you don't want to go through the tax estimate, then you need to look at what bracket you're in and probably add 15% for self-employment tax. And the bracket you're in plus 15%, put that aside in a separate account.
This was great. I now want to jump right into the good stuff, the deductions and tax opportunities. My first question for you, Dan, is, in your experience, what are some common tax deductions YouTubers often overlook?
All of them. Many of them. So the thing we have to understand is that the tax code around deductions say that an expense is a deduction if it's ordinary and necessary. Ordinary and necessary. And so that's why we have this sort of gray area in the tax code, because what is ordinary and what is necessary, it depends. Depends on the nature of the business. I was just talking to a client who they own a studio and they helped train actors. And they recently went on a trip that they paid for personally to see some shows in Broadway and connect with some folks in New York City that are kind of in the acting community. They're based in another state. So they traveled out there, paid for airline tickets, paid for meals, et cetera, et cetera. They paid for the shows. Now, typically speaking, entertainment under the current tax code is not a tax deduction, 0%. Okay. But is this entertainment for someone who is training other actors and actresses? Maybe, maybe not. I would argue in their case, this is not entertainment. This is research and development.
Got it. They
have an obligation. It would be entirely ordinary for someone who's training other actors to go and study current trends.
Yeah.
And arguably, it's necessary. How are they going to continue to compete unless they can be relevant and talk about current events and what's happening for these people who are aspiring themselves to maybe make it to Broadway at some point? And so that travel and those tickets is research. Now, me operating a CPA firm, if I'm going to go to Broadway, that's going to be entertainment for me. That's where it's relative, right? But as a YouTube content creator, it depends on the nature of your channel, what the type of content is that you're creating that's going to open the door for you to take other deductions. I'll give you another example. I had a client come to me. They were under audit with the IRS. They'd worked with two other accountants, the original preparer on the return, and then someone else was trying to help them with this audit. And the agent was just disallowing every single deduction. They're a manager for musicians, for bands.
Okay.
And they had a ton of concert tickets and a ton of meal expenses. And the IRS was like, hey, these need to be, a lot of this is entertainment. This is not a valid business deduction. We're going to throw that aside. You got all these meal expenses. You don't have receipts for these, et cetera, et cetera. I got pulled into the case, and I pointed out that this is research and development.
Interesting.
She has a requirement to study what these other bands are doing. Otherwise, how is she going to properly advise her clients? And so I showed him the court cases, and I showed him the statutes around the obligation to keep receipts for transactions $75 and above. And a lot of these transactions were under $75. End of the day, we won that audit essentially. And she had a few things that were disallowed, but ultimately the majority of it was mostly because she didn't have actual receipts for larger dollar amounts. But ultimately, it depends. What is the nature of your business? What are you out there doing? And I can give you several other examples. Yeah. Client who's food tourism business. So a lot of her meals out were researching what other restaurants are doing, both in the city that she operates and in other cities that were competitors of sorts. And so I got some content creators as clients who review restaurants, or they do a bunch of travel and they review travel places and experiences. So a lot of those costs are ordinary and necessary for their business. How would they even create the content unless they were out there doing it? And so it's a categorization issue. It's not meals, it's not entertainment, it's research.
Okay, so that's under the research segment of your tax, like when you're setting up your taxes.
Exactly, yeah. So categorization is really important. This is sometimes it's so difficult for people to articulate what we're doing within my firm and what other firms do. Like, why are you guys more expensive than the $400 person I just talked to? Whatever it may be. It's like, well, it's these little nuances that make all the difference.
Yeah.
There's a code at the top of a tax return. that most people ignore. It's a 6-digit code on a business return. That actually makes a ton of difference in terms of the type of business that you operate, and therefore what would be considered an ordinary and necessary expense. And so if you're not strategic about that code, you're going to be evaluated differently by the IRS, and they're going to flag different types of expenses that seem out of line for your business. There's things that you might mark as, I know that travel expenses, meals are some of the most scrutinized things by the IRS, but are a lot of your expenses actually travel and meals, or are they research? Are they marketing? I have a guy who is really into motorcycle racing, and he does all of his marketing and networking at motorcycle racing events, and he branded a lot of his company around that. And so are those motorcycle expenses, or are those advertising and marketing expenses? Advertising and marketing expenses, they could be valid expenses and would not look abnormal to the nature of his business. But if they were all travel and other personal items, they're going to be disallowed. So it's really being strategic about properly categorizing the actual nature of the transaction to then make sure that it is going to be allowed by the IRS, but also whether or not you look like a risky client to begin with.
Yeah.
So those are little nuances that are hard to articulate unless you can literally show someone, here's how you're doing it now, here's how we do it, and here's why that's meaningful to you in terms of how much more you can deduct, as well as how we've actually lowered your risk profile. The game is pay less tax, have less risk. It's not just less tax, have more risk. Less tax, less risk.
Less risk. I like that. That sounds way better than more risk, more tax. You brought up something that I was intrigued to hear. It's like you said, court cases. If an audit was to exist, you utilize court cases to prove your point. How often are you doing that, and how could YouTubers even maybe think about that strategy?
Yeah, all the time. So give you a little bit of context. So Congress writes the rules.
Yeah.
They write the tax code. The IRS does not write the tax code. Congress writes it. The IRS has been given authority by the Department of Treasury to interpret and enforce the rules that were written by Congress. When they interpret the rules, do they always get it right? Not necessarily. Sometimes it's vague. So, but they're still trying to do their job. That's the thing I always try and remind clients. Like, this is just someone else trying to do their job.
Yeah.
So let's be respectful of that. That goes a long ways, actually, if you're helping them do their job better, right? They're just trying to do their job. Now, a lot of times, big corporations, sophisticated investors, folks who maybe just have a lot at stake or want to make a point, they disagree with the IRS, and they're not just going to pay the bill. They're taking it to court, to tax court, and sometimes it can go all the way up to the Supreme Court. It typically goes to tax court, and that's where we get really authoritative guidance on how the rules are actually going to be implemented. So we get a ton of insights about that, about different strategies from the court cases. See, I don't try to take on a bunch of risks for clients. I don't try to pretend like I'm this super innovative person. Only innovate where you differentiate is a philosophy that I subscribe to. And there are other folks who've already taken the risk for us.
Yeah.
I just need the innovation actually is just finding those strategies and then copying them.
Got it.
Because it spells out, here's what the position is of the IRS, here's the taxpayer's position, here's the arguments that they laid out, here's what the court case has decided, here's why they're ruling. You're getting the whole, it's like getting the Chargers playbook. Of course, no one needs the Chargers playbook because they're terrible, but imagine how they'd lose by 80 to 19 or whatever it was the other day instead of 63. Anyhow, you're getting the playbook, and then all we got to do is copy that. Then similarly, the IRS publishes audit manuals.
Got it.
And so this is public record, just like court cases. And so that's giving us the recipe when you put those two together of what we need to do. And so strategies that I show our clients are based off this actual research, and we build the documentation. Again, that's how you pay less tax and you have less risk, because we're not speculating on what we're capable of doing. We're just copying it. That's painstaking, masochistic work to go through those things, right? So I jokingly say, like, do you hate yourself enough to like go through all these details and read all this information? Probably not. That's why you work with a team like mine that goes through all those details. But if you're a YouTube content creator, you can't sleep tonight, and you need some melatonin in the form of text, pull up some IRS tax court cases, and you'll get some insights there.
What are your tools or resources that you go to find these court cases?
I mean, that's somewhat challenging for the individual consumer unless you know the specific issue at hand, and you can put into a Google search, like, this is the issue plus tax court. Yeah. We have specific research tools similar to what a law firm would have. There are a couple main providers, Thomson Reuters, CCH, and they give us, in this tax research software, they have the whole archive, and we can sort by and search and all kinds of stuff to find the applicable court cases. Okay. AI is also, I have a whole AI for accountants program, and so I'm trying to help other accountants get caught up on ways to leverage AI to be a better professional. And AI in research is going to be really powerful in terms of finding you all of the potential court cases that would apply to your specific situation.
For you, the next question I have for you is, what are some of the most common tax mistakes you have seen among content creators that you're just like, why you guys keep doing this over and over again? Just so that the people out there listening can be like, okay, maybe I'm in the process next year of doing that.
Yeah. The biggest mistake is organization.
Okay.
Just having everything in one place, or at least a consistent place. There's a whole notion in finance, consistency over accuracy. Now, accuracy is getting it right. Do the numbers match? But you might get the numbers correct, but if they're all over the place and in different categories, you're inconsistent. You can't really glean what's happening or put together a compelling case or really infer what the right decisions are.
Yeah.
So biggest mistake is they've got transactions mixed between a bunch of different bank accounts, and some is personal, some is business, credit cards, etc. And they're waiting until the end of the year to try to go through all these different accounts and label what things are. They end up missing a bunch of deductions. There's all these studies on just the impact on your cash flow in general by consistently organizing your information and getting timely financial information. Consistency and timeliness typically improve someone's cash flow by 30 to 50%.
Really?
Simple,
wow.
Simple organization. And there's some neuroscience behind it. Things like the mental accounting bias, just by the ways in which we bucket our money, significantly impacts whether or not we're making sound financial decisions. So having the wrong organization, you're going to miss a bunch of deductions. And at the same point, if you're ever to be audited, it's very difficult to maintain business deductions where they're coming out of your personal account and not consistently coming out of your personal account. So it's really advisable to just get one specific business account and put everything through that business account or that credit card account. So you've just got it all in one place.
Got it.
That's the biggest mistake. From there, having the right entity. So are they making the S election? Is that timely? From there, figuring out the right salary. And then from there, making sure they understand all the things that they are eligible for. Things like the Augusta loophole, implementing an accountable plan, paying your kids, properly characterizing transactions so they are not going to be disallowed. Yeah. Thinking about home run strategies like, hey, I want to get a vacation property. Well, if I buy a vacation property and I use it as a short-term rental for a year, I can create a tax loss that I can use to offset up to 100% of my business income. Now I funded a goal of getting a vacation property while also minimizing my taxes. In other words, I funded a lot of my down payment with money that I would have otherwise just given to the IRS.
Incredible. That is that's incredible. I didn't even know that that was something that existed.
Yeah, with the beauty of doing the short-term rental, I mean, there's administrative challenges and things, but if you're able
Yeah.
to fund the place that you want to travel to anyways, and there's some
Yeah.
personal usage rules and stuff, but now when you're traveling out to check on the place that you wanted to vacation to, that's probably a business deduction for the travel there because you're checking on a property. And so now you're adding some other deductions to go somewhere that you wanted to go to anyways.
Is there a specific tool that you would recommend, like if they can get it now to organize this, what would be that? Like I see online you can get TurboTax for $49 during Black Friday. Would that be the route to go, or do you have any recommendations that you could share with the people?
Yeah, TurboTax is going to get a return done for you, but is it going to help you pay the least amount in tax? No. There's a lot of things that you can't do in TurboTax that someone with professional grade tax software can do, and there is a big gap between the two of those. So if you're just looking to get the job done, TurboTax can probably get the job done for you. You're just checking a box. You're not optimizing your taxes.
Okay.
In terms of organizing information, the best tool is just to have a bank account that's just used for business.
Okay.
And I tell folks, if you've only got, it's only you don't have any employees, you got a few transactions a month, you don't need QuickBooks. You don't need some extra monthly charge. Put everything through that one bank account. Once a month, dump it into a Google Sheet or Microsoft Excel and just categorize it. This was marketing, this was research, this whatever this may be. Do that consistently month after month. At the end of the year, you'll have everything you need to complete a tax return. When you get to a point where you're multiple six figures, you've got several different transactions, multiple bank accounts, maybe you've got employees, that's when you're going to need something like QuickBooks.
Okay.
If you're going to go to QuickBooks, you need to anticipate also hiring a bookkeeper, because the reality is you got to play your game.
Yeah.
Unless you're an accounting content creator, your game is probably not messing around in QuickBooks.
Yeah.
I know this because your books suck and you do it on your own.
Sounds like you talking to somebody specifically.
Yeah, I'm talking to a bunch of specific people need to hear this. Find someone who knows how to utilize QuickBooks, and the way to cut through all the BS and figure out, do they know their stuff, is you just ask them, what is the most important financial statement? What is the most important financial statement? They're going to probably tell you the P&L, the profit and loss. And you're like, hell yeah, that's what I care about. Money in and do I have profit? And that's the incorrect answer. Correct. It is important, but it's not the most important. The balance sheet is the most important. That's where we see assets, liabilities, and equity. Why is it the most important? Because if the balance sheet is wrong, the P&L is wrong.
Yeah.
So when you get paid, that's money into your bank account. So if your bank account balance is wrong, guess what? Your revenue number is probably wrong. Or you pay someone, your bank account balance is wrong, you're missing some expenses. I just was talking to a client. I was looking at the balance sheet on their tax return. I was like, this makes no sense. This thing called retained earnings is supposed to reconcile with the schedule on the next page. It doesn't reconcile. I could show you, here's 3 different reasons why I know that it's off. It's off by about 10,000. I said, do you have a credit card with a balance of about 10,000? Because that's how much your retained earnings is off on this tax return. They said, well, yeah, we do. It's like, well, it's not on your balance sheet. So you're missing probably $10,000 in expenses. You're roughly in the 35% when we add in state and local taxes and everything else. So this little these transactions that aren't on the balance sheet, or this account not on the balance sheet, is costing you like $3,500. So if your balance sheet is wrong, your P&L is wrong.
Yeah.
So they need to get that correct and then be able to explain why it's the most important. Because if they don't think it's important, then they're not making sure it's right consistently. And then I look at it and I go, what is, you got all these negative balances. Like you got a Chase credit card. Dom, I have seen this so many times. I pull up someone's balance sheet and I'm like, you got a negative $38,000 balance with your Chase credit card. That implies that Chase owes you 38 grand. I'm pretty sure on a credit card, Chase ain't owing you 38 grand. Right? But it's negative. They're like, yeah, Chase really doesn't. That means you overpaid on your credit card. You're like, hey, cool. My balance is 10 grand, but I'm feeling pretty good today. So I'm just gonna give you 48 grand. You go ahead and just hang on to that until I'm ready to spend. That never happens.
Yeah.
People, right? So the amount of times that I pull up people's financial statements and I see all these negative credit card balances, payroll liabilities, you're like, the IRS owes you money? No, they don't owe you money. You just haven't reconciled this. So you're missing a ton of expenses.
And they know how much you owe. And if you do not pay, you go to jail.
Well, here's the thing. They look and they match your 1099s and all this stuff. And they go, oh, you're under what we were expecting. They send you a notice.
Yeah.
You report over what they're expecting. They're like, we're cool. We're good. They're not sending you a notice. It's like, hey, we noticed you reported too much revenue. We want to make sure you're good. Should we send you some money back? Make sure you double check it. They're not letting you know. So if you show a bunch of weird numbers, that means you overpaid.
Yeah.
They're not telling you that.
Got it. That's wild. And is that a pretty common thing? People overpay?
Yeah, absolutely. I mean, part of what we've done for the last 15 years, I realized 15 years ago that there was nobody targeting small business owners with tax planning, the type of tax planning I was doing for big companies and sophisticated investors. So we start doing that work. And step one, let me review the last 3 years of your tax returns, because that's how far we can go back and amend.
Yeah.
And it's rare that we don't find a situation where there's at least one mistake on their return. What is the typical relationship someone has with the CPA? They fill out some form. They send it in with a bunch of random documents. Sometimes you got like scribbles on notepads. Stop doing that.
Yeah.
Stop with the scribbles on a notepad, especially if you have really bad handwriting. Like, I don't know what that means. But you got all these random documents, right? You send it in, and then they send you back a tax return. You're like, okay, cool, we're cool.
Yeah.
Right? So how are they possibly going to capture all these deductions and credits? It requires conversations, someone knowing your business, knowing your goals, understanding what you've been up to. Oh, you traveled to New York to go to Broadway and you have this business teaching people how to act. Guess what? That should be a business expense. You paid with your personal account. We need to have you reimburse yourself for that and get it into the business account. The only way I know that is by having a conversation. Accountants generally don't like to have conversations with clients.
Wow.
So you got to find the folks who want to have those conversations, go through, hear your story, know who you are, so they can say like, hey, did you travel this year? I know you like to go out to Broadway a couple times a year. I don't really see this. Your travel numbers or your R&D numbers, they look low. They understand who you are, what you have going on, types of things you're going to be doing, and then they're going to help flag those for you. But a bunch of scratch pad notes and random yes or no stuff, that's not getting the job done.
I have one last question for you. I'm going to just find a bunch of random things I bought this year for my YouTube Kids channel. And I would like to see if you could tell me, how should I itemize this or categorize this? So, or if it's something I cannot tax or at least get incentivized for.
Cool.
My AirPods, I bought these last week. Could I itemize these as a tax expense?
And you use those AirPods to conduct calls, meetings?
Meetings
for business. Did you buy it for a business purpose?
No, but now I'm starting to find myself utilizing this a lot more when we do recordings and things of that nature. Would that be considered a something I could?
So would it be ordinary necessary for someone operating their business to have a pair of AirPods to conduct phone calls and otherwise? I'd say generally yes. I would probably take the position that it was a business expense.
The second thing is downstairs in our kitchen / family room. I converted it as a backdrop for some of our videos. Now I did put new cabinets in there. I painted the wall, new like nice forest green. I put some ornaments and things of that nature. We utilize it within our scene, and it's taking up the family room space. Could I somehow use that as a business write-off?
So the expenses that you incurred to set up the whole studio, I think those would be ordinary necessary business expenses. In terms of them being able to claim a portion of your house, utilities, depreciation for this area, this would fit under the home office rules.
Okay.
And under the home office rules, that area would have to be exclusively used as a studio.
Okay.
So if it's exclusively used as a studio, then we would measure the square footage compared to the rest of your house. And let's say it's 10%. We'd take 10% of your utilities and some other depreciation as a write-off.
I am looking to buy a new Xbox. Is that a write-off?
I think the only way that it would be a write-off is if you had a bunch of Xbox-related content for your
channel. Okay.
Or if it was used as a prop.
Okay. That makes sense. Yeah. We're definitely not using it for a prop. Now, this might be a really gray area. I buy a lot of toys for my kids. They're 3 years old, and it's generally the same toys that I utilize in our channel to teach the kids. Can those be thrown into the write-off for my business?
I would say if you bought it for the business to create content, and then later your kids used it as they just were playing around with it. My kids are in my office all the time playing around with the stuff they got in the office.
Yeah.
And so if the business bought it with the specific intent to use it in this content, tax write-off.
Got it.
If you bought it as Christmas gifts for your kids, and now all of a sudden we're using this and dad's getting reimbursed for Christmas gifts, there is an element of intent that I think would make it difficult for you to take that position.
Okay. The last one is we buy makeup. This is a business expense. I use it with my business card. We do buy makeup for the actors in our shoot. Does that apply as a write-off for the business?
Absolutely. Yeah, ordinary and necessary expense for a content creator.
Awesome. I mean, I don't really need it, but I do buy it because
right. I mean, we can't all have that perfect complexion.
Dan, thank you so much. I think that was awesome. I think it's going to lay out some more episodes in regards to I think you specifically talked about state income tax. Also think about what if you work in the United States and then you do work in internationally? How does that apply? But these are things that can be set for at a later time. How can people get in contact with you? How can they start rigging the game and taking the knowledge, just a small amount of knowledge that you gave us right now, and be able to apply it to their life in the future and so forth?
Yeah, I think a couple things. Leave a comment below if you've got any further questions, and I'll do my best to respond to those comments. Also, you can learn more about me and my different companies and what I'm up to at riggingthegame.com. And if you're specifically looking for accounting help, you can find my firm at nthDegreeCPAs.com.
Thank you so much for your time. Thank you for helping me rig my game. I'm really excited I got all my business expenses ready to go and organized, and I'm excited to do something that I'm never necessarily excited to do every year, and that's taxes. So thank you, Dan.
Amazing. Thanks for all the questions. Appreciate it.